Well, I'm going to introduce myself. My name is Christopher Neary. I work for passiveinvesting.com. Today's topic is multifamily underwriting tips and tricks. I want this to be a very fluid conversation. I don't really have any notes. I would like it to be discussion with the attendees. And if I go on tangents, I apologize in advance. But I do have some guides here. So a few things that I'll discuss is using the same model each time with multiple versions and what that even means. Having multiple underwrites for the same property for different scenarios. Using the same softwares to create a process, or and the next thing, learn a simple yet effective process that can be replicated by each team member. Something that we call SOPs, or standard operating procedures, just to make it easier for when we have a new team member come on board, or if we need to say we don't close a property in a year, just to refresh our memory, to go back and see the system so not everything's super disorganized. So those are the main points. There's a few other things that we can discuss. And before I jump into it, there is something that actually just got released today. It's Multifamily Investor Nation Intensive. This is an in-person intensive that you have the availability to go to. It is in Columbia, South Carolina. It is on private lending. So it's going to be with Kelly Garrett and Angela Dunn. This is something I highly recommend doing. I've actually hosted an intensive in Columbia last year. It was very successful. We had about 20 to 30 attendees. So it's very intimate, small. It's a 2-day event. It does cost money, but it is a great way to connect within the private lending industry, as well as learn some great things with one of the managing partners and directors on our team. So there's actually a $500 discount for early bird. It's in the chat. We just posted there. So if you have any interest, I'd highly recommend checking it out. If not, no problem. Another thing I'd like to mention is just the firm that I work for that I mentioned, passiveinvesting.com. We're a commercial real estate firm based out of the Carolinas. We focus mainly on multifamily. We have branches for car wash, self-storage, and hard money lending. Kelly Garrett, the managing partner I just mentioned a minute ago, who will be doing that in-person event in September, alongside Angela Dunn. But if you want to meet some of the team members, you can do that on our page. If you want to learn about some investments that we offer currently, you could do that. You can learn about past videos or education or the properties that we own, anything you'd like. Feel free to check out our website, but let's jump in. So today, obviously, we're talking about multifamily. That is something that I'm on the multifamily acquisitions team. I've been part of this team for a few years now. So I have underwritten a plethora of deals. I don't know the exact number, but each year, anywhere from 400 to 600 deals. What I mean by that, it's fully underwriting. It's getting into the modeling, putting it in Excel, and giving a verbal to the broker of where we are. So that's what an underwriting process looks like. You source a deal. You underwrite that deal in your model. Doesn't matter which model it is. A lot of times for multifamily, it's in Excel. And then you typically will visit the property or give an offer of where the deal makes sense for you. And if it's close to where the seller wants, then you buy the deal. It's that simple. Obviously, there's a lot of nuances to that and tips and tricks. So something that when you have a team like we do at passiveinvesting.com, that's you have multiple people working on a deal, it's really important that you create multiple versions of an underwrite. What that means is you have an Excel model. I'm talking about the first bullet point I have here. So use the same model each time with multiple versions. So you have a model, an Excel model that either you've built off someone else, you have taken from online resources that are free, whatever it may be. There are so many models out there that you can use. You need to obviously tailor it to your needs. But when you do start a underwrite for a new deal, it's important to stamp that model as version 1. You need to have a starting point, and obviously start with a clean model, but you need to have a starting point, and that's your version 1. Version 1 is better than version none. That's what our partner Dan Handford always mentions. But so getting started, creating a version 1, and after that, say you put in your rent roll and your P&L or your trailing 12 financials, and you have either you want to get back to it another time, or you have a team member that also wants to work on it. Before we adjust anything, what we'll do is we'll create a copy, Command V or Command C, Command V, and make a version 2. And what that does is it stops anyone messing up or corrupting that version 1, where you're comfortable with the numbers in the model. This is obviously simple, but it's super effective. To give you an example of how many versions we have for a deal that we get close on, we can have anywhere upwards of 25 versions on one single property. That's not uncommon. The reason being is throughout a marketing process, you can have a time frame of anywhere from 3 to 6 weeks, even longer than that. You have ever adjusting debt markets that you need to continuously update. You need during that 3 to 5 week period, you'll probably get an updated rent roll at a certain point. So updating that rent roll, you'll need to create another version. Taxes, you'll have an assessed value that might come out that's new. A lot of assessed values for 2023 are coming out between August and our tax bills between July and September. Obviously depends on where you're investing or buying or looking. But that's another reason why you'd create another version. It's just very, very important that throughout each step and each adjustment, you have copies and different versions of these underwriting. I'm sharing my screen, and I see there's a comment here. Sorry for pausing in the middle of this. I'm not seeing the speaker or his screen. I am sharing my screen. It's just the generic Multifamily Investor Nation screen, showing the topic and the few things I'm talking about. So I'm just talking to you guys. So there's really nothing that I'm sharing talking notes wise. But if there's any questions in the meantime, please, I'd love to answer them. I'm going to pull up the question answer. I don't see anything. No questions have come in. Okay. So moving on from that, you during a process of an underwriting for multifamily deal, we've had upwards of 20, on average, probably about 25 versions per deal. Reason being, if say there's a mistake in taxes, you can always go back to that previous version, or you can always refer back to the steps that you've taken to make sure that everything has gone correctly. And if you need to go back, you easily can. That kind of leads me into the next step, and I talked about this very briefly, is multiple underwrites for multiple scenarios. So say you're close to that 20th version of a property, and you've vetted the location, you've vetted the rental comparisons, you've vetted the everything other than the debt markets is what I'm trying to get at. So the last point and the most challenging point right now is your debt. Typically, you're putting anywhere about 50 to 70% leverage on these deals, unless you're a very wealthy individual that can put all cash, unless it's a small deal, of course. But what we do towards the tail end of the process is make sure that we have a debt matrix or debt quotes from either a debt broker of some sorts who we'd like to work with, or we go to banks and we get soft quotes. It's just like getting a mortgage for your single family residence. You'll basically, in that, you'll get pre-approved. However, in multifamily or commercial, you'll get a debt matrix of the options that you'll have in the current market environment. And what you can do is, a lot of times your options are fixed rate interest or variable rate interest, which means it's floating. So what you can do is just create 2 copies of that. It's it's not a final version, but the most up-to-date version of your model, and you can name it, say it's version 15. Version 15, fixed rate debt, and the same thing, version 15, floating rate debt. And you can model those two separate debt options and see what's better for the return metrics and what's more feasible, what gets you more proceeds, what the options are. Say you get floating rate debt, what a rate cap will cost, and will will that funding come from investors or internal, or will that come from the debt provider? So there's a magnitude of variety when it comes to debt. And when you get towards the tail end of a process, you will most likely have multiple underwriting showing the multiple avenues of debt that you can put on the asset. And this is very crucial, especially in a time like right now, to continuously update these versions. If you guys aren't aware, the debt markets have been bouncing around. They're extremely high. I mean, I'm talking July 2023 if you're watching this on a recording, but I think a trick or a great resource to check continuously is a site called Pennyford. I'm sharing my screen here, so if you could see this, just let me know in the chat box. So this is Pennyford.com. This is a quick way of seeing the treasuries for today. This is, a lot of times for multifamily properties, you're getting a 5, 7, 10-year fixed rate from the agency provider, whether it's Fannie, Freddie. HUD obviously is a little bit longer, 30 to 35 years. And a lot of these agency providers are basing it off the T-bills or the 5 or 7 year treasuries. So a lot of times they'll give you a spread. Let's just say we are discussing about a Class A property, 200 units in North Carolina. And what you typically get is you'd need to get a DSCR coverage ratio of 1.25. So say that's priced at a 5% cap rate. Your debt will be based on, your proceeds will be based on that coverage ratio, as well as a treasury. Say we're going with a 10-year 10-year term. So they'll take the 10-year treasury and they'll add a spread to that. What's the spread? That moves around. It depends on the asset quality, the age, whether it is a green property, meaning it doesn't produce that much emissions, et cetera, whatever. Really getting into it here, but typically right now we're seeing a 200 bip spread, meaning 2%, and then you'd add the 10-year on that. So you'd have a 5.754 fixed rate at a 1.25% DSCR, which could get you anywhere realistically where things are priced anywhere from 50 to maybe 65% LTV, loan to value. So this website's super helpful. This adjusts daily, even hourly. I refresh this probably 3 times a day. You'll see this bounce around a lot lately. Just for example, about a week ago, 2 weeks ago, before the jobs report came out, this 5-year was at about a 4.2% change. That's about 30 bips. So that could be anywhere from 6.75 rate to 7.05% fixed rate. So that's substantial. So it's very important to continuously update this in your model. And having different versions is great to see how much it's bouncing around, to see the changes in the environments, to see I like to timestamp it essentially or carbon copy it. So there's multiple versions. Obviously, this creates a lot of data within whatever, if you're using OneDrive or whatever storage on your computer, but it is worth it. It's really important to be able to go back and revert to the past. I see people saying, why don't you just update the newest info in the same model? It really comes down to mistakes. We're all human. And a lot of times there'll be human error in just importing a small digit. So making copies and doing this very frequently is really important. And you'll commonly note or commonly see your small little mistake or whatever it may be. That's why I do it. That's why I'm recommending it. Okay, I'm gonna take a pause there, a breath, just rambling on here. So I'm going to answer some questions that I see in the Q&A. Rob, great question. What is something you had to implement this year into your underwriting models that was different from past years? That's great. Something that came to mind immediately was adding in rate caps. This is pretty nuanced, but I'm going to go for it. And if it's over everyone's head, that's okay, because it's pretty deep into it. But we've added in rate cap. What a rate cap is we haven't added in a rate cap. We added in a rate cap price of where that will be funded or who will be funding that, because recently you can get a variable rate loan from a loan provider, and you can cap that. You can basically synthetically fix that rate. Say you get a variable rate at 8%. That's floating, that adjusts on a monthly basis. However, you can you would actually look at term SOFR. So term SOFR is here. I can't see it because I have all the chat boxes, but term SOFR is here. Typically, the provider will give you a spread. A lot of times it's higher than your agency spreads. Like I mentioned, 200 bips. For your variable rate, it would be 3.5 or 350 bips. And you could buy a rate cap. And there's actually a software called Chatham Financial, which allows you to price out, it's right here, to price out rate caps and costs and how long you want to cap the rate. What a rate cap is it won't allow that variable rate to go up above a certain amount. So they're called a strike price, 2%. So you get 350 bips of a spread and you buy a 2% rate cap on a $25 million loan. That will cost you 168 or 1,681,000. And you cap that interest rate at 5.5%. And what I'm trying to say is what we've implemented into our model is where that $1.68 million comes from. Does it come from the investor's money or the sponsor's money, or basically internal equity? Or what's recently occurring is you will get the proceeds from the lender. So it's a very nuanced thing, but just it's important where those funds come from, and helps with your sources and uses. So I hope that helps, Rob. We've implemented a lot of things over the years in our model. We've adjusted where we've gotten data from, or rather than taking from one source, we're now taking from multiple sources. Let's see. I'm going to stop there. I might come back to that quickly, but after answering other ones. Is the debt broker the same thing as a mortgage broker? Yes, essentially. Yes, it is 100%. How does getting a soft quote work? Great question. You find someone that works in the debt brokerage space. That's simple. Big providers these days are Walker Dunlap, CBRE, Newmark. A lot of these larger commercial real estate brokerage firms have their own mortgage broker arms, or debt brokers, they typically refer to them as, and you don't pay them unless they provide you with a loan. So you can just start creating those connections, those conversations, just network, and they will give you quotes without any cost. It's their job. But you have to make sure that their quotes are accurate and they give you great advice as to which avenue is the best. Obviously they get paid through doing business with you, so you have to be careful with that. But for the most part, they're great people to work with, and they're most likely, if you're working on a nice asset, they'll do better than what you would do going to a bank. I'm very new to this process. Can you explain what underwriting is? Yes, of course. Underwriting is just a terminology to get financial data from a property. You'll typically get a rent roll that's just who's living at the property and what they're paying, their start date, their end date, as well as a P&L or a T12, which means trailing 12 financials. It's just the last 12 months of your income and expense, your debt service as well sometimes. And then you just have a net operating income at the bottom, showing how profitable the property is before your debt. And underwriting is just taking those two financial documents and some other financial documents, whether it's your tax bills or whatever, putting them into a model, coming up with a pro forma, which is basically an assumption of what you can run the property at. Can you increase rents? Can you reduce expenses? And how much can you pay for this property and still be profitable? That's what underwriting is. Typically in multifamily, that all occurs within Excel. You may have heard the software called Argus. Argus is really used for more commercial commercial real estate, so retail, industrial, things with leases for whether it's retail, medical office facilities, things like that. Argus is used for that because there's more leases that it can be complicated. Put that in the software, and then a lot of times you'll move that that information from Argus into an Excel. So a lot of commercial real estate underwriting happens within Excel. I hope that answers your question. Are you sharing your screen? I am sharing my screen. Can you give, this is pretty nuanced question, but I'd be happy to answer it. Can you give some idea on insurance rate in Texas? Insurance has been a hot topic in the past 18 months, especially in places, states like Florida and Texas, and coastal markets, of course, will always be difficult. Right now, Texas is difficult because of a few past, call it natural disasters or freezes. We had one freeze, they had Harvey. So places like Houston that are a little bit more coastal have been a real challenge to get insurance. Say you're targeting a 1970 vintage Class C property, 25 units. It's going to be very challenging getting insurance, or good insurance for that matter, with good coverage in the state of Texas. A lot of times when referring to multifamily, this is a good tip or trick. You talk on a per door basis or a per unit basis, because a lot of times it's easier to compare a 150 unit asset versus a 300 unit asset when referring to numbers on a per unit. So I'm going to talk on a per unit basis. So when it comes to insurance right now, let's say in 2021, Texas insurance on a nice asset was about $600 to $800 per unit. That number has nearly doubled, probably doubled. It's anywhere from $1,200 to $1,700, upwards of $2,000 a unit, which is very expensive. So finding an insurance broker, just as there's debt brokers, there's insurance brokers, and it's a different world because you only can use one insurance broker. They block off carriers, it gets confusing. But using a right insurance broker that knows what they're doing within the specific market. You can have an insurance broker sitting in Kansas City, but works for the entire country. But sometimes it's better to use someone that's a little bit more local to the market. So using those people to your advantage, it's free service. They quote, they do the same thing that a broker does. They only charge you once they provide you with a true insurance that you sign up the policy. So I hope that answers. Do you model various exit strategies on your underwriting? Absolutely. Good question. Hold period. How long are you going to hold this asset for is something that we play around with on a deal by deal basis. Exit cap rate assumptions is a huge one. Where do we think it's really hard to predict where the market is going to be in 5, 7, 10 years? If you're family office, you're holding the deal for your forever, so it doesn't matter. But for firms that are syndication firms or private equity firms or REITs, they have to come up with an assumption of their exit, which is an exit cap rate. And you really need to understand where the current market is sitting, because that changes quite rapidly, as well as per product and per vintage and everything. You really need to be understanding of what the current market environment is and where things should be priced and where they have been in the past 10 years. What has been the trend? What do we see in the next 5 years when it comes to supply? So we do model multiple various exit scenarios, and a lot of times we'll get approval from up above, and that's where we go. But when you're in the market every day and you're underwriting a lot of assets, I gave that example of North Carolina before. Just knowing where there's also, this leads me into another point. There's also a delta between where brokers are marketing assets right now. So again, we're in July 2023. You have people who are selling their properties. You'll use a brokerage firm, and there's terminology they'll use for purchase price guidance is they'll use guidance because they're guiding you to the price that the seller wants. There's a whisper price. There's a lot of different terminology for it, but there is a delta right now. There is a delta right now between the guided price from the brokers to where that property actually sells. And knowing that is super important. You do not want to go hot and heavy and say, okay, this broker priced this at $30 million. And in the model, you're probably going to get to $20 million, $25 million. And it's okay to still offer at that price because there's a lot of groups, majority of the groups, all of the groups that are bidding on these are not hitting those numbers. It comes into the later stages when you're in the next round where you might get close to that guidance, or you might even still win a deal and not be at that initial guidance. So I think that's important to know, especially once you get into this. I think there's a very different way of bidding on a property from single family, even if it's your primary residence, to multifamily. A lot of times it's okay to lowball brokers and sellers. They're still open to selling. They still want to see an offer. But if you get an offer out, it's better than nothing. And what brokers really very much appreciate, and they'll continue to keep coming back to you with potential deals, is just giving them feedback. Even if you're significantly off of the seller's want or the broker's guidance, just giving feedback gets you a long way. All right, I'm going to take a breath. I've been rambling for 28 minutes, but I'm going to read through some of these questions, and then I'm going to wrap it up here soon. But I hope so far it's been super helpful. I see quite a few of you here. I would like to mention next week's webinar Tuesday is going to be Ed Gilmer. I believe he's talking about multifamily debt markets currently, which is going to be really interesting. It's a hot topic. It's something you really need to understand in order to buy properties and assets right now. It is essentially the bloodline of acquisitions. You need to have good debt. Good debt is relative, but you understand what I'm saying. So highly encourage you checking that out. Okay, I'm going to answer a few more questions here and then I'm going to wrap it up. But I see one here. Do you negotiate terms in order to get closer to asking price? Yes, absolutely. There's ways to win deals, not only by just the purchase price or the offer price or whatever you want to call it. You have terms, right? You have a due diligence period. You have a closing period. A lot of times you'll throw in an extension option during this transition period. You'll have earnest money deposits. You will have earnest money deposits that will go hard, meaning that they're non-refundable. All of these are ways that you can negotiate with the seller. And a lot of times it shows the confidence that you have within yourself and your firm. And it just kind of writes out your confidence within the deal and your confidence in closing the deal. Because a lot of times, especially recently, there are a lot of deals that have gone under contract, meaning they have a signed purchase and sale agreement, they're doing due diligence, they're raising funds, whatever it may be, and these deals will fall out of contract. They will drop. The seller will walk, the buyer will walk. Sometimes the seller will walk for whatever reason, but a lot of times these buyers are walking away from the table, and a great way to negotiate is putting up hard money or non-refundable money. You put up $250,000, you're a lot less likely to walk away from that deal. That's for sure. If it's a smaller deal, you put up $15,000, whatever it may be, it's all relative, but it just shows the confidence you have in with yourself, with the property, and etc. So yes, we do negotiate those terms. It is a long process. Negotiation could be anywhere from a day to a couple weeks, even a month. It just really depends. I think I'm going to pause there. If you have any questions that you'd like to ask me personally, I would be happy to share. I'll tell you my email. It's chris@passiveinvesting.com. I'm open resource if you guys are new to the multifamily world or have a deal and just want some guidance. I'm going to definitely use me as a resource. I hope you learned something today, and I want to thank you for coming.